Principles of finance, a la Shmup. Balance sheet. Okay, so we're going to add on a bit of complexity to our proverbial lemonade stand image here. First, we're going to think about our cash. How was the company started? Well, it got a loan of $5,000 from grandma.com. She didn't want to charge us interest, but our parents made her. They're real life matters kind of parents. So she charged us 10% interest or $500 a year for as long as we were renting that $5,000. Well, at the end of our first year, we have a financial decision to make. Do we want to pay off the loan fully or spend our $6,000 in after-tax cash profits on building a second lemonade stand? Well, our gut will tell us which way is most profitable, risk-adjusted, and that's what we'll do. Well, let's go back and restate our income statement to include the interest we owe on the $5,000 we borrowed. All right, there we go. So, a couple of interesting things to notice here. We added $500 in expenses via actually accounting for our loan to start the company. Well, before we had added that in, we had $6,000 in net profits. So it would be rational to think that we've just added $500 in expenses, and now our new net profits number should be $5,500. But it's not. It's better than that. Why? Taxes. Yeah, that $500 came before the government took its 25% bite out of us. Well, essentially, the government paid for a quarter of our interest expense. How's that work? And you can imagine that in very high tax situations, the incentive to borrow more money is much higher because the government essentially covers a lot of those expenses in the form of your being able to deduct the interest expense on the money you borrow, against the taxes you'd be paying on your profits. All right, another interesting thing to note here was that we generated $5,625 in cash during the year. Our interest expense was $500. We generated way more cash than we had in interest expense, meaning that our bankruptcy risk here is very low, which is good. And we wonder to ourselves, so how much money could I borrow if we wanted to go big with Lemonade Stands Are Us, lemonade stand on every corner in the country? Okay, and so doing a little bit of musing on the math here, like if our interest rate was 10%, we're generating with one stand over $5,000 in cash. Well, couldn't we borrow 10 times that number of $50,000? If we did a $50,000 borrowed, that'd be about $5,000 in interest. We'd still have more profits than interest. How much would it cost to launch a new additional stand? Would that stand cannibalize revenues from our first stand? Could we buy supplies cheaper if we had more scale or size? And how many licks does it really take to get the center of... All right, no, never mind. Okay, so we wonder about the ratios here that go behind debt, largely revolving around how much debt could we borrow if we wanted to max out. Well, we know that banks focus on an arcane term called EBITDA when they loan money. Side note, if we ever get a large dog at Shmup, we're going to name him EBITDA. Right. Well, what is EBITDA anyway? Well, it stands for earnings before interest, taxes, depreciation, and amortization. And in our case here, we'd calculate our EBITDA as our earnings of $5,625, but then we'd add back interest of $500 and taxes of $1,875. We don't have any assets we're depreciating or amortizing yet, so that totals $8,000 in EBITDA. And we use EBITDA to get rid of non-apples to apples things like taxes and interest, which can change a lot over time with interest rates moving and taxes being different in different states, different countries, and so on. And we do this so that we have a clearer picture of the basic operating health of the company. And it's often quoted as a multiple by banks when they think about appropriate levels for loaning money in the form of a debt to EBITDA ratio. And a ratio of 4 is often about as high as a low-risk seeking bank will ever want to go. 4 times debt to EBITDA. And that would mean that without paying enormous interest costs, Lemonade Stands Are Us could get a loan of about $32,000, give or take. That's 4 times that $8,000 there of EBITDA. So for a moment, let's think about maxing out our loans. If we found a bank stupid enough or visionary enough to trust us with a loan for $32,000 and they charged us 10% interest, amazingly, well, we could still make the interest payment. The bigger question question is, could we then use the 32 grand to open up, say 6 more lemonade stands at a cost of 5 grand each and still have 2 grand left over for whatever? All right, well, at first blush, our projections say yes. And if each of those 6 stands could themselves generate something like 5 grand a profit at the end of their first year, like the first one did, well, then wow, we could pay back all of the loans in just 1 year, and that feels a lot like how Starbucks got started. Yeah, it kind of was.